Hello, welcome on board AFM Advanced Financial Management. I'm Rashaad Hussain, your expert tutor for AFM. For more than a decade, I've been on a mission to guide and help students nail FM and AFM exam. This is a debrief of question Walditch Company. We're about to embark on a journey through a mock debrief for the Walditch Company. This is a 50-mark question, including 10 precious professional marks. Pay close attention to those professional marks because they're your secret sauce that can significantly boost your score. This question is on an exciting topic. Can you guess it? Yep, covering the syllabus areas of acquisition, mergers, cost of capital, ESG ethical issues, and also the professional marks. Now, I know it might sound a bit challenging, but trust me, it's going to be worth it. If you haven't attempted this question before watching this video, you're highly recommended to pause the video, attempt it, and then get back to compare your answers. So now buckle up, get ready, because this mock debrief is your ticket to mastering the essential concepts and techniques needed to tackle a similar question. Let's move on. Now, this question requires the following knowledge of valuation. When free cash flows are given, it is supposed to be discounted at WACC, and the present value what we receive is considered as the value of the firm or the business. Now, from this, we will have to reduce the value of debt in order to arrive at what is it? Value of equity. This value of equity, what we receive, when we divide it by the number of shares, we'll get the share price. Now, here in this question, we'll have to find out KE, KD, and arrive at the WACC in order to compute the present value. This question further requires us to have the knowledge that the target company, here the target company being the Tinkleton, it's given two offers. One, they can be compensated through the cash offer or the paper offer, which is called as share for share exchange. Share for share exchange. Now, in both of these, we will have to find out, yeah, what was the pre-acquisition wealth, and what is the wealth post acquisition wealth, in order to find out the gain, and we've got to get the gain in the percentage. Here also we've got to find the pre-acquisition wealth and the post-acquisition wealth of whom the Tinkleton company, in order to ascertain the gain. So this is what we've got to do as far as the computation part of this question is concerned. Now let's move on to the question. This question has got four exhibits, 50 marks requirement and two response option, namely the word processor and the spreadsheet. Let's go through the exhibits. No, that is not the right approach. You're not supposed to start with the exhibits. You're rather supposed to start off with the requirements. And let's open the requirements. And even before you read the requirements, let's have the requirements copy pasted into the word processor. Let's copy paste the requirement, copying it, bringing it into the word processor, pasting it into the word processor, and then organize it. After organizing, let's go through the requirement. It is asking us to prepare a report. So let's start putting all the headings that are required for the report. So how do we start? It is the report. It is the report to directors directors of Walditch Company. Now let's see what are supposed to be the parts of the report. When we go through the requirement, we'll be able to pick it up. And obviously, a report has to first start off with an introduction. What are we discussing? And then we need to calculate profit or loss on sale. So the A1 speaks about calculating the profit or loss on sale of the infrastructure support division, and then they're asking us to calculate the percentage gain or loss to the shareholders of Tinkleton Company under both scenarios. What are the both scenarios? All shareholders accepting cash offer, or maybe all the shareholders accepting the share exchange offer, and concludes solely on financial grounds whether Tinkleton shareholders will accept cash or share exchange. Now, these two doesn't have it doesn't have anything to maybe put as headings to the report. Now, let's see point number three. Discuss the problems which achieving the forecast operating synergy from acquisition. Oh, so that is something which we can put up reasons. We can put up a heading reasons why forecast operating synergies may not be achieved. Okay, now what else can should we discuss in the report? And the steps which Walditch Board of Directors can take to achieve the synergies. Okay, then we can put a heading steps to realize or rather achieve the synergies. Achieve the synergies. Now, the next requirement discuss for both share exchange and cash exchange offers. So we need to discuss about the share exchange, another heading where we discuss about share exchange, and also another heading about the cash exchange. And what else? Share exchange and the impact of Walditch financial situation of the purchase of Tinkleton and the likely reasons of Walditch company's shareholders. Now, what else? Yeah, all the report has to have a proper conclusion. And finally, after the conclusion, the report should have what is it? The report, the closing of the report is compiled by, okay, and then a date should be there, and whatever appendix is it going to follow. Now appendix 1 would be the first, yeah, what is the first requirement? Calculate profit or loss on sale of the infrastructure support devices. So this could be the first part where we write profit on sale of infrastructure support services division. This could be one part, and since it is a calculation, I would refer to, yeah, I'll recommend it to do it on the spreadsheet. So refer the spreadsheet for this. And then one more appendix, appendix 2. Now what is that second computation, which speaks about calculate the percentage gain or loss. So let's have that one. The next one is the gain bar loss for Tinkleton shareholders if cash or share exchange offers are chosen. Again, it's working note, refer spreadsheet. Now let's read the question in order to pick information for the report as well as the computation part. Moving on to the exhibits. Moving into exhibit 1. Once again, if you have still not read the question and not solved it, you're requested to pause the video, go back, try solving it, and then get back. Now moving into the highlights of require exhibit 1. This company, Walditch Company, has got a reputation for well constructed buildings, and they are criticized for not making much use of technology. This company has made a major investment in infrastructure support services. And what has happened is that infrastructure support services has not delivered the profits which they were expecting. And for this, the Walditch board of directors are criticized for lack of understanding and not giving clear strategic direction and not leaving clear strategic direction. Now the status is that they are deciding Voltage is planning to sell the infrastructure support services for $18,250 million, and this would consist of 25% of Voltage company's current assets and 25% of the assets and current liabilities. The assets is worth 68,960 million and the liabilities is worth 4,860 million dollars. Now, with this, we'll be able to draft the first appendix where we'll be able to find out profit on sale of infrastructure support services division. Let's move on to the spreadsheet. Now, with appendix 1, where we are trying to find out profit on sale of infrastructure support division, where the consideration on sale of division is given as all the amount in dollar million is 18,250,000. The less 25 percentage of value of Walditch company assets, which are worth 68,960, and current liabilities, which are worth 48 4,860. Now 25 percentage of 25 percentage into 25 percentage, and what is the profit from sale? So it is equal to this minus this is going to give me, this is the profit from sale now. So the profit from sale is dollar 2,225 million. Now, further from this exhibit, we'll be able to bring in and mention in the report. Let's add it to the report. We can probably specify in the report. As far as introduction is concerned, we are discussing about what is it, the profit on what is it, sale of infrastructure support services. Okay, and we can also mention that one of the reasons why the synergy is not achieved could be because they will have to learn from failure of what is it? The infrastructure support services. What are the suppose services before they integrate ratio. Okay, so these are 2 points that we can pick from this exhibit towards the report. Now let's move on to the second exhibit. Now here, this exhibit, it speaks that Walditch is about to acquire the share capital, the entire share capital of Tinkleton Company, which is specializing in smaller commercial and retail development, and they are primarily successful because of use of technology. Now there are three Tinkletons executive director who own 15 percentage of the shares each. There has been very good relationship. The relationship between the senior management and the employees are really good. Now Walditch is planning to acquire this company. Why? Because they see opportunities for synergy by using Tingleton's technology, where they'll be able to increase their own efficiency. Now the next relevant information will help us to find us the value of Tinkleton company prior to acquisition. What is given here? Here it is given that the profit PBIT, the profit before interest and taxes provided, we are provided with non-cash expense. There is an annual cash investment of 173 million in non-current asset. The free cash flows would grow by 6 percentage per year. The cost of capital is estimated to be 13 percentage. Further, the tax rate is 20 percentage per year is the tax rate, and the Tinkleton has got $1,200 million one ordinary shares in issue, and they are proposing, Walditch is proposing two methods for acquisition. So what are the two methods? One, a cash offer of dollar 17.3 for each shares in Tinkleton, and the other one, share for share exchange, where 5 shares in Walditch for 6 shares in Tinkleton. Now, what will happen? This will become an wholly owned subsidiary. So, Tinkleton would become a wholly owned subsidiary, assuming all shareholders accept the cash offer. Now, with this information, let us find out the value of Tinkleton Company prior to acquisition. From the spreadsheet, and which would be part of what is it? Appendix 2, where we are calculating the gain bar loss on for Tinkleton shareholders if cash or share exchange offer exchange offer are chosen. Now the first thing that we'll need to do is find out working note 1, where we are trying to company or the value of what is it, value of Tinkleton company prior to prior to acquisition. Now prior to acquisition particulars, and what are the particulars? PBIT is given. How much is the PBIT from the question? The PBIT is 1300. What is the amount in dollar million? And then we've got next one, tax at the rate of 20 percentage into 20 percentage, and we can add back non-cash expenses specified in the question of 419. Further, less investment in non-current asset, which is 173. Every year they are investing. Every year they are investing in the non-current assets. Now, with this information, we've not been provided with the depreciation details. We'll be able to arrive at free cash flow, and the free cash flow shall be the sum of all of these. And the free cash flow is, how much is it? 1286. There is going to be growth. The growth of free cash flow is stated in the question as 6%. Further, it is specified that the current cost of capital is at 13%. Now, using this, I should be able to find the present value, or rather value of company. Now there is growth, so whatever is the free cash flow, multiply it into 1.066 percentage divided by, in the denominator, what is KE, 0.13 minus 0.06 would give me, how much is the value? The value is 19,474. I can round it off to 74 if required. 74. And what is the number of shares in the company? Number of shares in the company is 1200, again given in the question there, and that will help me find the value per share. The value per share is this value of the company divided by number of shares, and that tends to be how much? It tends to be 16.23. So what is it? The price, the share price of Tinkleton prior to acquisition is dollar 16.23 per share. Okay, so this is, we've not done with appendix 2. Appendix 2 is where we have to find out the gain, and in order to find out the gain, we've got to calculate post acquisition value. So finding out the post acquisition value, we'll have to find out the value of the combined company. Picking information from the exhibit to the report, certain points that we can now bring into the report is that in the introduction we can include that we are looking into the Tinkleton company shareholders cash or share exchange preferences. We can also discuss about the synergies forecast, and as well as the reasons why the forecast may not be achieved is, one may be poor management of employees. uh, we've noted that Tinkleton has successful and loyal teams. Now just having the headings highlighted, underlined, bold and underline. Hmm. Further, as far as steps to realize synergy is concerned, we can do one thing. This Tinkleton previous directors, we can involve them in the management. So that can be done by, what is it? involving Tinkleton previous directors in new management. And we could also ensure prompt communication communication to employees, that would motivate them. Further, as far as share exchange is concerned, we can add a lot of things up here from this exhibit. What is As far as the share exchange is concerned, it's going to help us retain cash position. These are only points, and how these points we take it into full sentence, how the sentence is supposed to be, will come up subsequently. And we are supposed to mention about the share exchange, retaining fund in the business, introduction of new shareholders is going to happen. There is going to be change in shareholding pattern when we go ahead with share exchange. And obviously more number of shares is going to lead to dilution of EPS. And finally, how this 5 for 6 share exchange share exchange, how is it determined? What is the basis? It's not specified in the question. Now, as far as cash exchange is concerned, that might also be attractive. Why would it be attractive? Cash offer, it would be attractive because there is certainty of returns. We know what we are receiving. And also, what is it? It is uh, convenient to exit route. It's a very convenient exit route. It's a very convenient exit route. And what is being done here? The cash offer would require of 1,200 million shares into dollar. How much is offered? 17.3 would amount to. It would amount to dollar 20,730 million. 20,730 million. Now, what question is what we have is, what is the source of this fund? Source of funding this is unknown. Now we can probably say that it is from the sale of, what is it? We can probably say that it is from the sale of the infrastructure support services. But the infrastructure support services gives only, what is it? It gives only dollar 18 mil. What is it? 18,000 250 million. There is still a shortage of, what is it? Dollar 200 2,000 510 million. It's no way specified in the question how the shortage of fund is going to be managed. So these are some of the points that we can pick from this exhibit towards the report. Moving on to the next exhibit. The third exhibit, it states that it is assumed that the acquisition will take place, the disposal will also take place. It gives us idea about how to find out the value of the combined company. And it is stated that the revenue is estimated to be 46,600 million. The profit margin, which is assumed to be post acquisition, without the post acquisition operating synergies, estimated to be 18 percentage. The operating synergies are stated as 750 million pre-tax. Walditch pays a tax at 20 percentage per year. The year one combined company would require additional investment of 426 million. year 2 to year 3, there is going to be growth in the, what is it, pre-tax profit, including the operating synergies. It is going to grow by 10 percentage every year. Additional investment is going to grow by 8 percentage. Year 4, it can be assumed that the free cash flows will grow by 7 percentage per year. uh, Further, the value of the company, so value of the company, it is assumed that the, what is it, the cost of capital, the WACC, Walditch WACC is not provided. We'll have to find out the WACC. In order for that, what is it, $5,000 million one shares, its value is at, what is it, 20.41 is the pre acquisition value. The market and book value of the loan is also, debt is also provided. The pre-tax Walditch uh, KD, cost of debt, is provided 8 percentage. Equity beta is 1.26, and the risk-free rate of return is estimated to be 4 percentage. And finally, we've got the premium, the risk premium, which is 7.4. We've got 1,200 from it. This was given in the previous question as well. Tinkleton has got $1,200 one ordinary shares. This was given in the previous exhibit as well. Now, where do we start from? We've got to go and find out WAC. K is not there. We'll have to first find out K. So let's get into the spreadsheet. From the spreadsheet, next working note. This one, working note number 1 is there. Now let's do working note number 2. Working note number 2, which is going to be calculation of cost of equity, which is going to be based on CAPM, where RF plus beta into RM minus RF. Using that, the information given here, what is RF? It is uh, zero point zero 0.04 plus 1.26, beta has specified, into the market risk premium is 7.4 percentage. Market risk premium is 7.4 percentage. So rounded, it is rounded to, what is it, 13 percentage, is 13.32, rounded to 13 percentage. We have calculated the cost of capital. Now going to the next working note, where we are going to, what is it, calculate calculation of WACC of Walditch. And what are the columns? Whenever it comes a fund value, the proportion, cost, and WACC. Now, what is the value of equity that is given? The equity value is 500 share, 5,000 shares at 20.41. It was already given in the question. And the value of the long term loan, which is 23,780, specified in the question. Using that sum, finding out the proportion, like the proportion cost given as 13 percentage above. And here, what is the cost? It's written, what is written in the question? The pre-tax cost of debt of Walditch company is 8 percentage. 8 is pre-tax, so we've got to make it post-tax. So 0.08 into 1 minus 0.03. Is the tax 30 percentage? No, it is 20 percentage. It's 20 percentage. So that gives me, what is it? It gives me 6.4 approximately, proportion into cost. And the WACC. How much is the WACC? The WACC is 11.75, which, for the discounting purpose, the WACC is rounded up to, what is it, rounded to 12 percentage. Taking the back is 12 percentage. So this is the discount factor which we are going to use in order to discount the cash flows, the free cash flows. Now we've done with all working note, and we should be able to now do the next one where we are finding the equity value of the combined company, which is going to be, what is it, combined company, which is post acquisition. Now what all informations, see the particulars, we are speaking about 1, 2, 3, 4 years in picture, and 5 onwards there is, it is into infinity, was very clearly specified in the question. Now what all is given in the question, starting from where we've got the revenues that are coming up. Here you can see the revenue. So the starting line where we can start is from the sales revenue. Now, how much is the sales revenue? The sales revenue in the first year it was stated as 46,600, and the most important thing is 46,600, and the most important thing is to ensure that as far as presentation is concerned, everywhere do not miss the amount is in dollar million. The amount is in dollar million, and this is growing by, how much is it growing by? It will grow by 10 percentage, growing by 10 percentage every year. Hmm. Then what do we have? Then we, from this we should find out pre-tax profit margin, which is at 18 percentage of this, 18 percentage of this one, to which we are provided with operating synergy. Operating synergies in the first year it is 750, and this is also, as stated in the question, is growing by 10 percentage. From this arriving at the pre-tax profit, all of these together, and tax at the rate of 20 percentage into 20 percentage will give us post tax profit. The post tax profit, and it is further specified that in order to find the free cash flow less additional investment, as specified in the question, how much is the additional investment? It's going to be 426, and then it is specified in the question that this is going to grow by 8 percentage every year. This is going to grow by 8 percentage every year, the additional investment, and this will help me arrive at, what is it, the free cash flow. Now the free cash flow up to fourth year, what does it say? That after year 4, look from the exhibit, after year 4 it can be assumed that the free cash flow will grow by 7 percentage per year for the foreseeable future, that is into infinity, after taking into account the additional investment. And here it is going to grow at, what is it, 7 percentage into perpetuity. Now using all these, what is it, we've got discount factor at the rate of 12 percentage, 1 divided by 1.2 to the power, and the final year 1 divided by 0.12 minus the growth of 0.07 and multiplied by the previous year discount factor, discounted cash flow, and this gives me the present value, that is total combined value of company. And that is going to be the, how much is it? It is, now putting zeros properly. How much is it? It is 149,008. From this, what did we learn? Whatever value we get the combined company, we need to reduce, what is it, less the value of equity, sorry, less the value of debt, in order to arrive at the value of equity. What is the value of debt? 23,780. When we reduce this, we will get, what is it, value of equity. So this minus this will help me arrive at the value of equity. Now this value of equity is of the combined company. Though we've got two shareholders. So number of, see what is important, number of, what is it, Walditch company shareholders. How much Walditch company shareholders? We've got 5,000 shareholders. Now number of, what is it, shares, number of shares issued to Tinkleton. How much is issued for them? 1,200 divided by 6 into 5. How much shares? 1,000 shares. So the total number of shares is going to be, what is it? Is going to be 6,000. This will help me find out the share price post acquisition. Post acquisition. And how is it? The value of the equity divided by the total number of shares. And how much is it? It is 20.87. The share price post acquisition is $20.87 per share. Per share. Okay. Now we have found out the post acquisition value, that is post acquisition share price. Now we've got to find out what is the cash position, what is the cash offer gain, what is the cash offer gain. The Tinkleton company pre-acquisition share price has already found out, has already, what is it, 16.23. 16.23. Where above here, what is it, 16.23. Preferable to give to go select it, 16.23. From where, working note, which is from working note 1, working note 1. And now cash offer for each share has specified in the question, which is 17.30. 17.30. Now what is the gain? The gain per share is this minus this. Now it is very clearly specified in the question that we need to find out percentage gain for Tinkleton shareholders. And percentage gain is going to be this divided by their initial and converted to the percentage. How much is the percentage? The percentage is around 6.6 percentage, is around 6.6 percentage. This is as far as cash offer is concerned. Now what about the share for share exchange offer is concerned. Share for share exchange offer is concerned. For this, let's put it up particulars. Let's find out the share price pre-acquisition, what is going to be the number of shares in the concern, and what is going to be the, what is it, the wealth of Tinkleton shareholders. Now, what do we have? Pre-acquisition. What is the share price? Is going to be 16.23, and post acquisition is, post acquisition has found out above, it is 20.87. Now, the number of shares initially is 1,200, but how much is only issued to them? 1,000 is only issued in case of exchange. So this into this, the wealth is going to be, this is going to be the wealth pre and post, and with that we should be able to find the gain in wealth. The gain in wealth is going to be 1,395, and in terms of percentage gain in wealth is going to be this divided by this and putting it across in percentage, and that's going to be 7.2 percentage. That's going to be 7.2 percentage. Now, using the information here in this exhibit into the report, the report would should definitely include the impact and the concerns of the Walditch company shareholders. It's not just Tinkleton company shareholders. We also need to bring in their concerns. Now, as far as why the operating synergy may not be achieved, see, it may not be achieved due to a lot of reasons. Maybe overestimation or changes in market condition, maybe inadequate plans or failure to adapt to changing circumstance. So it could be maybe due to overestimation, maybe because of changes in market conditions, maybe inadequate planning and or planning, or maybe even failure to adapt to the adapt plans to changing circumstances. Hmm? Now, as far as steps to achieve synergy, uh, see, it's not specified in the question how the synergy is. Huh? So we need to do further analysis of the of sources of synergy. We can list actions in order to achieve them. List actions to achieve them. That means achieve synergy. We can also look for assistance from Tinkleton company management. Why not also involve them well? We can, you see, involvement in the word, involvement of Tinkleton company directors on the board. What is our purpose of keeping them on the board? for the technology purpose, technology expertise. Hmm. Further, as far as share exchange is concerned, there might be objection of objection from the Walditch shareholders, because comparatively the Walditch shareholders gain is not up to mark. In cash exchange, we can probably state that the Tinkleton, see, the share for share exchange gives you 7.2 percentage gain, and the cash exchange gives you only, what is it, 6.6. So there is only very, very, very small difference, very small difference. And because of that, Tinkleton shareholders may prefer cash offer. Why it is only lower marginally lower gain, not a very huge difference, because cash offer is going to give them certainty, convenient exit route. So these are the points that we can pick up, which has to be elaborated from this exhibit. Now, picking up the next exhibit, the final exhibit discusses about persuading Tinkleton shareholders to accept the acquisition offer. And we have a problem here. What is it? Three Tinkleton directors, they own 45 percentage and they are quite dominant. Now, in order to persuade them to accept the acquisition offer, they're going to be privately offered jobs. They are also given cash bonuses if they take up the jobs, and the management is planning, if they've got no role for them in the management post acquisition, the management is planning to dismiss them once the acquisition is completed. And that doesn't sound ethical. Now, with all this information, let's give the report the final finishing points, what all points we need to bring in into the report. Now let's see, we've put everything quite required in the introduction. Introduction has to be very precise, and as far as the reason why forecasting operating synergies may not be achieved, what all have we mentioned? We've mentioned overestimation, change in market condition, inadequate planning, failure to adapt to changing circumstance, poor management of employees, Tinkle and a successful loyal what is successful and loyal teams, learning from the failures. So what else could be the reason why? Maybe we've got, what is it, insufficient time and money to have this properly uh, integrated. There may be, we can see that, see, there's a big ethical issue, isn't it? So there could be conflict between the work culture, or management styles of the styles of two companies. Mm, and it could also be maybe because of, what is it, failure to incorporate this Tinkleton company satisfactorily. Now, if you don't satisfactorily incorporate them, yeah, it might affect this energy in the long run. Now, the steps to realize them, what all points have we listed out? Further analysis, list action to achieve them, assistance from Tinkleton, involving Tinkleton previous directors in the new management, prompt communication with the employees, involvement of Tinkleton directors for the board of technology. What else? We need to have a very clear, what is it? We need to have a very clear plan, clear integration plan. Integration plan has to be there, and this plan has to be, what is it, it has to be flexible. It needs to consider, what is it, the staff concerns, and maybe the, what is it, staff resistance. Hmm. And further, share exchange, we've discussed everything. And cash exchange, yeah, we need to mention that it's not just about Tinkleton. We need to bring in Walditch as well. The Walditch shareholders, how do they feel? Shareholders might feel that the, what is it, the cash offer is too high. There's a chance of that. And the last thing that we need to bring in is the conclusion. We need to conclude. We need to very properly conclude. And what could be in the conclusion? Not just say that go for cash offer or share offer, rather an what is it, unbiased. We need to give a lot of things which probably the board of directors can uh, conclude from this. So this is not clear which offer shareholders of Tinkleton would prefer. That has not been specified in the scenario. Now, whatever option they go for, we'll have to discuss on the impact of the Walditch company available funds. How is the funds going to be affected? And we also need to discuss on the impact on the shareholding pattern. So this is all that we've got to take care as far as the report is concerned. Now, all these points, if drafted has a proper full sentence, will be now coming up on the screen. Organizing. Once the points are drafted to full-fledged sentence, this is how the report is supposed to look. And heading, introduction, followed by, you can pause the video to read through the report. And the second heading, reasons why forecast operating synergies may not be achieved, followed by steps to achieve synergies, and then share exchange, followed by cash exchange, and finally the most important, conclusion, with a proper report compiled by date and appendix references. And now moving on to the next requirement, requirement B. That requirement is requesting us to discuss the ethical consideration from Walditch and Tinkleton viewpoints relating to what the possible private offer of job and the cash bonus that are given to the directors. So we are supposed to write on it for 5 marks. Taking you into the word processor, here the question is. This question requires two perspectives, the perspective of the Walditch company and as well as the perspective of the Tinkleton company. Now, speaking about the Walditch perspective, the main ethical issue here is that this type of private job offers breaches the fundamental principle of takeover, and it also breaches the equivalent treatment of shareholders. So offering, and not only that, the offering of private jobs don't appear to be genuine. The Walditch directors could be accused of bad faith and lack of honesty, and this cash bonus that is given to the Tinkleton directors, it is difficult to justify it for business reasons, and hence would be considered as additional consideration for directors, meaning that, what is it, there is no equal treatment. And speaking about the Tinkleton company, there is going to be conflict of their own personal interest and the interest of the Tinkleton shareholders. If there are very sound reasons, takeover regulation would not prevent taking up jobs with the merged company. But there has to be very sound reasons. And whatever they get has to be transparent. So they have to be transparent of what they have been offered. And during takeovers, the local takeover rules and disclosures has to be followed. This is what has to be added to this requirement. And the points are has given. The Walditch points to elaborate and Tinkleton points to elaborate. And done with all the requirements. As far as Walditch company is concerned, that's it for now. Wishing you all the best for your upcoming exams. This is your AFM expert tutor, Rashaad Hussain, signing off. Thank you.